This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes. Yeah, but our value probably happens most when things are bad, right? Active managers do the best when markets are going poorly because they have the ability to act differently at a time when the majority of money is trending in a particular direction.
G'day everyone, Luke Laretive here from Seneca Financial Solutions with my friend and partner in crime, Dylan Pargiter Green.
Oh, you are so close. You are absolutely so close.
One season I'm going to get it right.
You will get it right by episode 34, I reckon.
I reckon, if we make it that far.
Yeah, look, 34 is, I reckon that's a good target.
Dylan, who have you brought in with you today?
Today we have my actual partner in crime, or partner in financial planning, Daniel Palmer. Danny or DP?
Yeah, all the above.
All of the above.
Been called worse.
We've got DP, DPG.
And LL.
And LL. You missed the memo.
I definitely missed the memo on the Ds. Okay, today we're going to talk about a little bit about active managers versus passive. So whether you're investing in index funds or with managers or how we combine those for clients. It's obviously probably one of the most common questions that I get asked. I don't know about you guys.
Oh, massive.
A lot.
And I'll get on my high horse about active management, and Dylan and Dan can whack me, and we can go from there. So look, should we do our market wrap for the week?
Yeah, let's do market wrap. We'll start off with.
Dylan, why don't you do it this week? What's the market done this week? Have you been watching and paying any attention?
I've been paying heaps of attention. You know what? One thing I have been paying attention to this week is NVIDIA, and their reporting.
I knew you were going to bring this up.
Well, it's pretty unbelievable. What do they have? Year-on-year growth of almost 100%?
Nah, yeah, big numbers. But the stat I've got in my brain, like the earworm about it that I got in my brain, is they've put on the market cap of Tesla in the last 6 weeks.
That's nuts.
So I stole that from Scott Galloway. So apologies, Prof G. But it's a really good way to think about it.
It's a great story.
And look, I think the story with AI is pretty simple. And I don't think you're going to hear a lot of people talking about it. It's not going to be something that's going to come out, but it's AI replacing humans. And whether it's in our business or in any big business, you're just going to see people slowly being able to outsource more and more to the computer. And it's not a pretty story. It's not something you want to hear about, but I think it's already started.
Yeah, and it's pretty unbelievable. I don't think we've seen a company like NVIDIA grow in the way that it has for quite some time.
Not at that scale.
Not at the scale. And I'd say the utility that it brings to a pretty broad market's pretty unbelievable. This isn't a podcast about individual stocks, but I wanted to bring it up because I think I've had about 14 conversations about it in the last week. And all of them revolve around whether or not I should buy NVIDIA or not.
Would you buy it? PA, your own dough?
Yeah, I'd put a little bit in it, I reckon.
Right now?
Maybe not right now, but maybe in a week.
In a week. Dan? You buying NVIDIA?
Yeah, it's one of those emotional buys at the moment.
You both got FOMO, I reckon.
Yeah, absolutely. Absolutely. We're terrible. We don't
make yourself feel better and lose some money. That's
absolutely.
Yeah.
Absolutely.
Look, not for me at the moment. Too rich for my money, but definitely, I think cost saving from AI is something that if your own personal business or a business that you want to invest in has leverage to it. You've only got to look at like the meta results to kind of get an idea of what you can do with a computer these days. So anyway, quickly through the stock moves or the market index moves for the week. ASX to Friday night's close down sort of 18 basis points. Small caps outperforming large, industrials outperforming resources, and global indices had a pretty good week. China, the best week, 3.7% up. Been saying it for a while.
It's coming.
Sleeping giant, the old Chinese economy. Everyone forgets Japan was up like 25 or 30% last year. And I think Chinese economy on the bounce. That's my tip for the year.
Pretty tough year last year.
I think it's neg 30 at the moment.
Okay.
Index in China. So whether you look at the Hong Kong or whatever, but yeah, their equities are cheap, super cheap. Not saying it's the time to buy right now, but I think it's getting close. Getting close. So interesting one. Should we push on? Because I reckon active versus passive is going to take
a while.
15, 20 minutes.
We could be here till Friday.
All right. Guys, why don't you start? Tell me a little bit about how you guys use active and passive at Bold Wealth. And then I can talk about how I use it.
Yeah, for sure. So I think that first and foremost, active and passive investments today we'll probably talk mostly about equities.
Mm-hmm.
They do both play a part in bonds and real estate and even cash to a degree.
Yep.
But what we'll generally be talking about is index-based funds that are tracking a particular index.
Equities
indexes.
Market cap weighted.
Market cap weighted, not equal weight or anything like that. Versus managed funds who have a human portfolio manager picking stocks based on an investment thesis.
And like a manager that's not buying leverage portfolio. It's not a complicated strategy, like a sort of basic long only or a basic long short. That's kind of what we're talking about.
Yeah. So, at Bold, we are strategic investors. We're horses for courses investors, right? So we go to professional investment managers like Seneca and some others.
Very good manager, Seneca.
The top.
Very good managers, Seneca. And we get guidance based on what the client's goals and objectives are.
Always a good place to start.
That is where we always start, as you've all heard before, and where they're at as well. Mm-hmm. So a good example might be Danny deals with a lot of our accumulator clients, and generally speaking, they've got pretty simple goals, and not necessarily a significantly large amount of capital. And so perhaps we'll work with them to get their entry into the market into something that's more index focused, maybe with a degree of active management, but the capacity to outperform at that point is not there.
Yeah, or the desire. I think, whether you choose an active or passive manager, the first question you need to ask yourself is, do you want to outperform? Now, whether you're an advisor asking that on behalf of a client, or you're just a client, or individual yourself, is if you're not interested in beating the market, doing better than everybody else, and you're happy just to take a, average return on the year, like a market cap weighted index strategy is going to give you, by definition, an average return.
And that's exactly it, right? Like people come to us for exposure to the market sometimes. Yes. They don't come to us because they want to shoot the lights out all the time.
Or even, look, I think active management gets a bad rap because of that. I think it's either this idea that we have to generate market returns for free or near free, or you have to get 10% above benchmark. If you compound at 2 or 3% above benchmark for 20 years, you're going to have a lot more money than someone who was just at benchmark.
Yeah, and also there's a lot of, I think, concepts around the 12-month reporting period. We smashed the benchmark this year by 10%. Oh, well, they must be an amazing fund manager. Well, no, wrong. Yeah. Wrong. So, like accumulator clients, Danny?
Yeah, so I guess especially when people first start, I think it's about education as well. So it's educating what passive is, what active is. There's a lot of accountability, a lot of behavioural changes. So I think it's about when people are first starting, have that cash flow, might not have that capital. It is just educating, going, right, let's get into the market. Let's make those changes so that we can see that growth. You can see positive change. Because even just taking that first step to see an advisor, that's a huge first step. And so I think people putting that, opening that door, just starting that, once they grow their capital, then we start to go, right, well, remember that discussion that we had around the active management, the purpose of it, what it does. Let's start exploring that as well. And it all, as you said before, it all just depends on what people's goals, ambitions are.
And it comes down to risk.
Well, Danny makes a great point. I think that what's more important than investing, what's more important than active versus passive, is that when you do make an investment, that you stick with it for long enough to benefit from it. And I think first-time investors are so sensitive to short-term, what we would consider relatively short-term movements in their portfolio valuation. So I think it's so much easier as an advisor to coach somebody first time into the market and say, hey, whatever your returns are, they're the same as everybody else's. Hey, you might have lost money, market might have gone down, but it's only gone down as much as everyone else's portfolio has gone down. And I think that's such a powerful psychological coaching sort of tool, rather than like kind of what I do, which is they can always blame me. They can always be like, oh, well, it's just Luke that's the problem and I'll go over and see Dylan. When in reality, that's not necessarily true.
And that's one of the products. You deal with a lot more wholesale investors. Mm-hmm. They are not, wholesale sophisticated investors. They are not first time buyers.
Well, most of my clients come from other advisors.
That's right.
So like that, I don't have people who are novices. They're annoyed, shall we say, with their current returns, and then they come to me to get better returns.
Yeah, and then what you said before, though, right, about the fact that clients, when they're first in the market, they don't want to feel like they've lost. You don't want to pick the team that gets the wooden spoon in the first year
Correct.
of picking a team in the AFL. Like, kids who pick the team that gets the wooden spoon generally don't become huge footy fans.
Correct.
Right? So if you're just following the market when
or if you're the bench warmer like me on the footy team, and you don't want to play season 2 because they don't let you on. You only go on when you're up by 30 and you get to put in the back pocket. It's no good.
Well be on the sideline.
I might as well cut the oranges anyway.
I might as well. You cut a mean orange. I've
symmetrical.
Symmetrical. You cut out that little white pithy bit in the middle.
I tell people this would turn into a counselling session for me every week, and here we are already. It's already the beginning. So childhood trauma.
So I think, look, to sum up, when we're building, clients' portfolios, it really does matter what the client's objective is, but it also matters what stage they're at, what level of capital they've got. There's a whole range of different questions, and I think as a very, very starting point, always general advice, but have a think about where you're at before you just go, oh, I want to pick this active position, or I want to pick this super concentrated position. Or if you've got, if you're a little bit into your investment journey, probably think about whether or not you really should be exposing yourself to the full market, whether or not you could be doing more, because chances are you could. I think it's a really great segue to talk about, some of the myths around active management and active versus passive, mm-hmm. because people think that they...
very dogmatic in their beliefs.
That's right. So, people will often say, people can't outperform the index. You can't beat the market.
That's not true.
It's not true. It's fundamentally like it's false.
You might not be able to beat the market.
That's right.
The average person might not be able to beat the market. The average investor might not be able to beat the market. Doesn't mean necessarily that you're an average investor.
Yes, and to be fair, I think one of the problems with this argument is that over a very long time the index has done very well.
Well, markets do well. They go up like 7 or 8% per year.
Well, that's exactly it, right? Markets grow. Markets are a reflection of the value of goods and services being exchanged in the economy.
Don't agree, but we'll pretend like we'll pretend like I do.
At the end of the day, a stock is a company. A company does something that people consume as a service or a good.
Okay, so I'll respectfully disagree, and I'll say that markets are over the long run mean revert and roughly follow earnings growth, which is kind of what you're talking about, right?
Yeah.
Profit growth. However, in the term that matters, which is most people is like a more medium term kind of basis, the market is like a prediction machine. So what it is, it's measuring the predictions of every market participant about a particular stock on a particular day at a particular moment in time. So it's more like a prediction machine trying to aggregate all the available information as best as possible to come up with a consensus view. And that sort of, I think when you take it out of the idea that it's a perfect play on GDP growth, it is if you wait long enough. It's kind of like playing blackjack. If you hit on 17 enough, you will lose. You just got to play enough hands.
You just got to play enough
Sometimes
hands.
you go to the casino and you'll end up, winning, playing that strategy. But if you play enough hands, you will lose more money than you make.
Yeah. And I think that's probably where we think, we're often thinking about 20-year or 30-year time horizons for a lot of clients, as well as needing to think about how to maintain short-term performance, low volatility, those sort of things. So
yeah, I think that the for me, maybe the clients are a little bit older
That's right.
And I think that you need to be able to help them achieve their goals, whatever they may be. And I don't always think that buying, particularly, Australian indices, for example, where you are heavily weighted to banks and resources, is necessarily the best representation of economic activity in Australia.
So let's talk about that, actually, because that's a huge topic and it's something that we talk about a lot with our clients. We sent out an economic update to our clients recently, and there was, a relatively short part on what we do in equities and what we're feeling. But generally speaking, we're a little bit overweight international.
Mm-hmm.
We feel that Australia, whilst it has some benefit in terms of the tax structures, is a very, very small part of the global market. I think Luke agrees with me there.
Yep. Rare that I
Got there.
Yeah. Can we get that on Luke?
Harry, come on, let's go.
Yeah.
Opening, closing credits.
Opening, closing credits. Luke, do you agree? No. But one of the problems that we have in particular with the Australian index is its heavy weighting to the top, between 8 and 12 companies.
And they all do the same stuff.
That's right.
So, there's lots of, we always talk about Australian managers beating benchmarks or, international managers beating benchmarks. Well, it doesn't actually really matter, in my view, if they're beating a passive index. If you're comparing everything on an after-fees basis anyway, good returns are good returns. And if you've got a strategy that works, whether it beats the market in this particular period or not, I don't actually really care. If your after-fee returns are as good or better, than the index, then what I can get my alternatives are fantastic. So I think that people get a little bit caught up with these benchmarks like they're the only way or the sort of the base way to invest. And I think it's fair enough to think of them like that. However, putting 8% of your money in Commonwealth Bank, a mature business, as a young person, to me, is dumb.
Well,
I want to invest in businesses that are going to be growing at faster rates of return than I can reinvest my capital elsewhere. And, the reality is those businesses aren't. And
the second thing to that is it's 8% in Commonwealth Bank and then 4% in ANZ, 3.5% in Westpac and 3.5%.
I think it's 20, don't quote me on this, but I think it's like 26.5% of the index at the moment.
Yeah.
Is the big four banks.
And then BHP and Rio and CSL make up, another 50?
Well, CSL's like 6 and then BHP. So let's say it's like 15 plus for Fortescue. Say it's like 18% iron ore, pretty much an iron ore warrant. So, a lot of investors are like, I don't want to invest in A2 Milk or Treasury Wines because they get most of their revenue from China and I don't know what's going on in China. Well, guess what? BHP, Rio, Fortescue, they're just leverage plays on Chinese steel consumption.
On steel, right? Unbelievable. So, I think the Australian indexes is something that you spend a lot of time on, Luke.
Unfortunately.
Yeah, because, you've spent a lot of your career working in commodity markets. You've spent a lot of your career working in Australian investment markets. Mm-hmm. So maybe, let's talk a little bit about Australian equities and when you're looking at active management in Australia, what are you doing?
Okay, so I've written a Livewire article, which we can probably link up in the thing, about this topic in particular, like how to choose an Australian active fund manager. But I think the most important thing is that Australian active management, when all the stuff you read about in the paper and you might see on TV from time to time, and the famous managers that you need to compare them not against each other, but against other strategies that employ similar techniques. So say, for example, our long-only ASX portfolio, Seneca Australian Shares, SMA, that invests in 20 to 40 companies from inside the ASX 200. It's unfair to compare me to a small cap manager. You're going to get a different sort of mix of risk and return for shorthand. Excuse me. In both those strategies. So you want to take all the managers who are doing something similar to me and find the ones who do it best. And best might not be the best returns last quarter or last year, like you said, Dill. In fact, the best managers this year, I think 7 of the top 10 managers this year were in the bottom quartile last year. So now that's not to say that there aren't managers who are more consistent than that. There are, In fact, there's probably a handful that I can point out to that have done really well across multiple time periods. But I think investors get a little bit caught up, trying to look at returns over a time series to today's point in time, rather than rolling returns and rolling alpha over time. Like, how much of the time is this manager outperforming? They might be underperforming right now, but if they're outperforming, 70 or 80% of the time, then that's actually, they're going to come good and probably sort themselves out. So,
and that's what an active manager is there for, right? Like, an active manager is following an investment thesis, right? That's not going to be the investment thesis that matches or beats the market literally every single day.
No manager outperforms every day.
It's not. Well, there was one.
There is one, and I'll see if let's give him a hint. He's dead. The guy who did it, he's dead. He died recently, 2021. We'll see if anyone can get this first time round.
I know who it is.
The boys know, so we won't play that. We'll play the game with you at home, and I'll give you a tip. He died in jail, and he's the only fund manager in history to ever outperform the market in every year. The
words Herbalife are just...
it's Bernie Madoff is the answer, right? So it turned out he was running a Ponzi scheme. So the
big old Ponzi.
The lesson here is that every manager underperforms. It's a question of how much they underperform by, how frequently they underperform, and how much money they make when they don't. And we did some analysis on, and I've rattled this off a few times, so apologies if you've heard me say this before, but we did some analysis on Australian small cap managers before starting our small cap fund. And over the last 5 years to whatever date we did that analysis to, I think it was mid last year, the top quartile managers in small caps in this country, which is like 30 odd funds, outperformed the ASX Small Ordinaries accumulation index by over 8%. The average manager in the top quartile. So that's of 90 odd funds or whatever. There was like 27 or something, whatever the numbers were. I can't remember. 96 funds and whatever top quartile of that is. So that's a lot of managers that you could have picked and done insanely better than the index on an after fee basis.
Yeah.
So to say to people that you can't sustainably beat the benchmark, you can't sustain it, and that's during COVID, huge volatility up and down. But I'm just saying, like that's a pretty impressive sort of stat.
Active management's there.
Can you find it?
Yeah. So can you find it? But in my opinion, active management is the investment side of financial advice, right? So clients come to us. When do we give the most valuable advice?
Yeah. No, they come to us. They've got all their, we talk about all their goals. We go through everything. And then we use these active managed funds with all the research that we have on hand that we know clients don't. And that's where our value comes in.
Yeah, but our value probably happens most when things are bad, right? Active managers do the best when markets are going poorly because they have the ability to act differently at a time when the majority of money is trending in a particular direction.
And that's how you use them. I mean, I in my experience, you want to find, if you can find an active manager who can outperform by 5% when markets go up on average, and underperform by 2% when markets go down on average, you're going to make a lot of money.
Yeah.
So I think that everyone gets scared into active management when things are bad. And what happens is they end up buying low drawdown, but overall low performance managers. Markets go up 75% of the time, 80% of the time. So what you need to do is find someone who can make money while the hay's shining, make you more money while the sun, make more hay while the sun is shining, and then lose as much or a little bit more when the markets are bad, but not get torched.
Yeah.
So for me, that's what active managers is all about. Whether it's the two strategies we run, or using the managers that we use across international and fixed income and the other asset classes where we don't operate, for clients. At the end of the day, that kind of characteristic is what I'm after. It's not so much trying to find these negative correlation, no correlation managers, because often trying to time them is really unless you're going to call the GFC, you're going to call COVID, you're going to get all that right, which I'm not clever enough to do. Avoiding drawdown, I know this is going to not win me any clients or whatever, but avoiding drawdown is a bit silly. What you want to do is minimize, make it less Like, don't do so bad, and then when the game's there to be won, go and fucking win it.
If you want to avoid drawdown, hold your money in cash.
Well, correct.
And
Well,
then try and time the market, which we all know just doesn't work.
It's
not possible. There was a very big fund manager who we won't name, who at one stage was holding 22% of their portfolio in cash. They ended up on the front page of the AFR, and they had outflows for months as a result. Again, not going to name them, but we don't want to see our people who are there to invest in equities
not investing in
equities because they think that they might see something on the
think
horizon.
our average
that
cash
is not their job.
Average cash position last year for our Centre Cross Shares SMA was under 2%.
Fully invested.
Like, we're always invested because I don't know what the market's going to do tomorrow. And any fund manager who does is a moron.
Yeah.
And that's our job as advisors as well. You know, being able to relay that to clients. I know through COVID, through 2022, because we're on the phones talking to all our clients, educating them, you know, when we're talking about balances, we're up this year, we're down this year, it's just as important to explain to a client why we're down as it is why we're up. Because then they get excited and go, oh, we're up. It's like, well, that's great. Just know that, you know, you might have done 20% this year. That might not happen next year.
It's going to mean revert, yeah.
Yeah. So just be aware that, you know, this is great, but it's just education. And I think to your point earlier as well about, you know, just being invested as well. Again, it's that education. I had a client meeting the other week, and he's held off for 12 months seeing an advisor. He goes, but what if I come on with you and I invest my money and tomorrow it goes down? And I'm like, well, you've had this, you know, look, the last 12 months you've wanted to waiting for a recession, waiting for all these things. You've missed out on all of 2023, and now we're 2024. And, you know, I can't tell you the answer to that.
Market's up 9% in the last 3 months.
Yeah.
Dan, can I ask a question about fees? Because this is interesting for me, right? Like, trying to market my business, trying to grow my funds under management. How do you think about fee load? You know, so you might have a strategy like mine at 45 basis points, which is pretty fucking cheap if I don't say so myself. Or you know, someone a normal Aussie equities manager who might be at more like 80 to 120, kind of all in. And then you think about, you know, like a private equity strategy at say like 2% and 20% performance fee on a hurdle as high as an ant. So talk to me about how you think about fees, after fee returns. You know, when you're putting a portfolio together for a client, is it the client's like, well, I don't want to pay the fees, or is it more like, well, just look at the after fee returns? Like, how do you kind of think about it?
Yeah, so I guess, again, depending on, you know, where clients are at, but let's just say retiree client.
Yep.
They've got the capital there. They know what they want. They've got their income that they require. I think it's just really about us doing our research to look at these funds, look at their objectives, what they've been doing in the past, what they're looking at forward, the research that they're telling us, and then looking at that fee structure. I think having you know, looking at it from an overall perspective, that, you know, one might be expensive. You might have a core satellite portfolio where half of your funds are tracking the markets, and then the other half are looking to produce that income for clients, maybe a little bit of growth. I think having just that diversification as that overall, that it kind of a lot of the time sort of works out in the wash as well, with you have some expensive, you have your index, but as long as we're achieving what the client wants without, you know, having a fund that's costing an arm and a leg, yeah, as long as we can get what we want and we're achieving those goals, then that's how we look at it.
So it's like value is what you get at the end of the day. You know, price what you pay,
right.
value is
That's
what you
right.
get.
Yeah.
And sometimes you can pay somebody and they do a good job. They don't give a shit really. You know, like it's and I think a lot with advice is like that a little bit too. You know, not all good advisors are the cheapest in the world.
No.
You know, and not a financial plan is not a financial plan. And you know, I think that finding a good planner, someone who's going to be able to not only technically deliver the right outcomes for you, but if you don't have confidence in them, if you don't think that they're a good person, if you don't think that they're able to, you know, be a bit of a stoic sounding board for you when things get difficult, you're not going to stick with it. And I think that people get way too caught up in the price they're paying and not enough interest and time spent on the value they're getting.
It shouldn't matter, right? Like if you've got an active fund that costs you 1% and gets 10% every year, or you got the index which costs you 0 but gets you 8% every year, What's returning you more after fees? It's the active fund.
Yet the client can still go on a holiday every year.
It's 10.
So.
Danny's here putting the actual practical financial advice application.
Don't be giving out practical advice on our podcast.
You are
come in here on your high horse about your practical advice people could actually use. We're not interested in any of that. We want to just talk nitty gritty that no one's interested in. All right.
Sorry.
Now, let me explain to you trust law. No. No, but seriously, right? Like, it's simple maths. 10% minus 1% is 9.
Yeah, I mean, just look at after fee returns. I think, Gavin, who works on my investment committee, has taught me lots and lots about particularly multi-manager, multi-asset investing. He's probably one of the best, smartest people that I know who does it. And the one thing that I've sort of learned over the journey is I used to be a bit more fee sensitive when I was recommending funds to clients. And we just don't even look at them anymore. We're just after fee. What has this manager been able to do? How have they been able to do it? Do we think they're going to be able to do that in the future and deliver the kind of results we're looking for to fit into our portfolio? And it's that simple.
How do you feel about performance fees?
Look, we take a performance fee.
Okay.
So on the small cap fund is a 0% management fee and a 20% performance fee. So we only take performance on our small cap fund. Because our view is that, like, we've invested our own capital in it, and we expect other people to do the same. So we're happy to be aligned, right? On the large cap stuff, you're never going to be able to generate sustainably 5 and 10% alpha. It's always going to be a sort of 1, 2, 3, 4, 5% alpha kind of equation consistently. So and there's a lot of work that goes into generating just that relatively small amount of alpha. So you need a management fee, and a low management fee that we charge is pretty reasonable, I think.
But
yeah, I've got no issues with performance fees.
I love them, and I particularly love them when we see funds like yours, where you basically put your money where your mouth is and say, cool, well, if we don't do what we say we're going to do, you don't have to pay for it.
But I think, Dill, you can do this with almost everything in life. Like, incentives matter. So, whether you are investing in a company, like, is the management team aligned? Are they financially incentivized to do the things that you want them to do? Are they emotionally aligned? Is their success going to mean their ego and their their personal worth going to go up? That's why everyone likes founder-led business. We always bang on about this, but like, that's kind of the same sort of attitude with fund managers. And I've said it on other podcasts, but like, if you're using a manager and they talk about founder-led businesses, and I've sat on panels and done this and made people look very silly, which I regret in hindsight, but the reality is that they talk about founder-led businesses. You ask them, how many shares do you own in the funds management company that you work for? It's that simple. Like, how much money do you have invested in the product? Like, all of my net worth is invested in my products. Yeah. And not only that, the company that owns all those products is the rest of my net worth. It's really, really simple that, I think businesses like ours, where you own the business and all your money's in it, like, you're going to do well because you need to.
Yeah. And that's probably a really good point about not all active managers are going to be the same.
No.
Right? Not all people are born equal. We do talk about founder-led businesses. We talk about people who have their own investment a lot in their own companies. And it's because
it matters.
It matters. And I think one of the things that is important for anyone listening is that picking an active manager is a lot harder than looking up the last 1 or 3 or 5 years of performance and seeing a good track record or seeing consistent, numbers and just picking it. Because if you don't know why they've those numbers, you probably shouldn't be having that conversation with yourself. You should be having it with a professional.
I agree. I think it's a really good way for us to maybe wrap this conversation on that point is that, you've got, you don't know what you don't know. And I think having a free initial consult with an advisor, whether it's us or someone else, should, all go on a plan, open your eyes.
If you see Danny, it'll definitely happen.
It definitely will. Dill and I maybe not so much, but
we're too busy making podcasts and
talking smack. The
cutting oranges.
Perfecting the art.
Look, it's like a sushi chef I am with those oranges. So you've got to have an understanding of what's available to you. You've got to have an understanding of what your objectives are, and then you've got to know how to map each one of those products to those objectives. And I think that is the crux of what an advisor is going to do for you on the investment side. And I think that skill and that process and consistently applying that process over time can add significant value.
Investing's a journey. It's a long-term thing. Long time. And one of the keys to the kingdom of that journey is that you need to be in it, and you need to experience highs and lows. And if you're not prepared to experience lows that are perhaps slightly worse than the market, but in order to experience the gains that are higher than the market, then perhaps you should be thinking about something more passive. You won't ever do better than the market if you go passive, though. You will just track the market, and you'll track it and track it and track it. Compounding's great, but that's the difference.
Boys, it's been a very, very interesting conversation. I'm hoping that everyone else enjoyed this as much as I have. I'd say this has been my favourite podcast.
It's been good.
So
It's
far.
been good. It's been good. Good banter.
Great to see DP here. Thank you very much for coming in, my friend.
Thank you, mate. Pleasure.
Thanks, mate.
Lovely to see you.
for settling us a couple of times.
That's right. I'm just Switzerland right here in the
He is Switzerland
right on
middle
the
there.
fence.
That's very good. Dill, you have a great week, mate. I will see you this time next week.
Such a pleasure, mate.
See you, mate.
Catch you, mate.
Bye.